Hi everyone and welcome to my latest webinar with me, which is Market Analyst at Hantec Markets. I've been holding these webinars every 2 weeks. We actually missed a week last week basically because we had a little bit of a problem with our audio, and I'm presuming that some of you who I know that were on that last webinar that we took had a few problems, and we've gone away and sorted it all out, and I hope that now we've got a much better setup and the sound quality is much better. I will ask you to, if you are having a few, if you think the sound is a little bit low, then maybe turn up the volume on your speakers. But also, if you are having any further issues with your sound, then please just message me on the chat box, and we'll see what we can sort out. But hopefully the issue has been sorted out. Anyway. On to what we're talking about this week. I'm going to talk about the stochastics. We did focus on this a couple of weeks back, and the reason I'm going to redo it again is because of the bad sound quality that we had, and I know that a few of you have been emailing in to ask us about this webinar, and we have decided to do it again because of that. So thank you very much for all that. Okay, so we're going to start with, as ever, the disclaimer. You do need to read this because I'm going to be talking about live market information, and in that situation you need to have read and understood our risk warning. As by now I'm hoping that you would have understood that I'm qualified to talk to you about technical analysis, having trained in the market for 13 odd years now, and I have technical analysis qualifications and obviously markets. And obviously having market experience does, I think, qualify me for that anyway. So, right, the agenda. We're going to start off, as per usual, with some theory behind stochastics, a bit of basics on the formula and calculation of how they get the indicator. Different uses of the stochastics as well, and actually how you can read the momentum indicator. A few signals that you get, which includes crossovers and, as per usual, with momentum indicators, divergence. And I'm going to finish off towards the end with a live market analysis. There's been a significant amount going on in these markets recently, loads to talk about. Hopefully we can get a bit of a discussion going maybe as to exactly what you're looking at, because I'm incredibly interested in what you are trading, and hopefully I can help you with that. But any questions you've got, please just fill them in on the chat box, and I'll get to them as and when they arise. If they are relevant to the what we're currently talking about, what I'm currently talking about on the slides, then I will broach that question then. If not, if it's more of a general topic, then I will come back to it towards the end. Right, so we're going to start off, as I said, with a bit of theory. Now, stochastics are just another form of momentum indicator. I've talked previously about the RSI and also the MACD lines. Now, stochastics, I believe, is a very good tool to use as a bit of a backup to the RSI. It works very well, I believe, in conjunction with it as a confirmation tool for trading signals, and I do use it quite a lot in my analysis. As it is an oscillator similar to the RSI. It ranges between 0 and 100 and uses 50 as your neutral level. A little bit of a different to the RSI in the fact that these trigger levels on the classic terms, the trigger levels are between 20 and 80. However, I will take you through exactly how to read them, and you will realize that there are different ways of looking at stochastics in different markets, and I will have to emphasize throughout this webinar that different markets are relevant for different indicators in different ways, so just be mindful of that. Okay, so just the basic premise is the fact that in a bull market, strong momentum would suggest that you've got the price closing towards the high of the range on the day, and that is your sort of premise behind the stochastics. In a strong uptrend, you want the price to be closing towards the high of the daily range. You don't want to be having price closing towards the low, because that would suggest a bit of a concern on the front of the bulls, and I think that is a little bit of an indication of possible loss of momentum, hence why the stochastics are very popular, because they tend to show that. Similarly, in a downtrend, you want the prices to be closing towards the bottom of the trading range to confirm that the price is still in a downside momentum phase. There is obviously the formula for stochastics. It's actually fairly simple. It's not as difficult as it might seem. It's fairly straightforward, and actually the formula gives us a couple of lines similar in that regard to the MACD, in the fact that you get two different lines to give you your signals on stochastics. You get in the fast stochastics you get percentage K and percentage D. I will then suggest that, or emphasize that most trading systems such as MT4, which I know a lot of you use, most trading systems will give you slow stochastics, and that's basically because fast stochastics are then subsequently smoothed to produce slow stochastics. So you've got your percentage K line, which is the calculation at the top. You then have your percentage D line, which is effectively a 3-day moving average of that percentage K line, and then to get your slow stochastics, instead of using percentage K, you sort of slow the whole process down by percentage K by using percentage D instead of K as your main line, and then having another 3-day moving average effectively of your percentage D line to make the stochastics even slower. So it just sort of removes a lot of the volatility out of the indicator and helps to smooth and give you better signals. So that's why a lot of people use slow stochastics. There is obviously the potential to change the parameters, as a lot of traders will use 14 days as your trading periods. You can change the number of periods you use, as I have talked about in numerous times on momentum indicators. You can use different trading periods to either give you more signals if you use less periods in the range. Say, for example, you use a 9-period stochastics, or you could use more periods, say like 21, and that would smooth the whole process even more. So in that regard, I will show you my first charts of the day. That is your stochastics. You've got the main line here, which is your percentage, effectively your percentage K line, and then you have that smoothed out by a moving average of that, a 3-day moving average of that to make your percentage D, and that is your signal line. Now, I spoke just now about changing the parameters. Well, this is using your 9-period, you've got a 14-period and a 21-period here. And that, as you can see, this sort of slows it all up. Certainly if you compare the 9 periods with the 21 periods, you can see this, the 9 periods got above the 80 line pretty quickly. 21 periods never even got above 80. So in terms of your signals or your trading signals you get, it does have a big impact on it. Additionally, this period here, I will highlight the fact that you had your a crossover, which I will talk about in a bit. You had a crossover signal on, if I get my crosshairs, you had a crossover signal on the 7th of July, and then on the 21 period stochastics, you didn't get your crossover until a week later on the 14th. So it took another 4 days, sorry, oh my God, my maths, another 7 days of trading until you got the confirmation on your 21 period stochastics. So it does make a big difference. So what I would say is go away, if you like the stochastics, go away, and you're interested in changing the periods, then go away and do your research, do your back testing, see what works best for you, see what works best for your trading strategy, and then adjust accordingly if so you desire. But I would certainly recommend still using 14. I know that when I do these webinars, a lot of people say to me, what how do I use the signals? Well, I always use the classic calculations as my signals, and I don't know. I mean, maybe that's maybe that's because some people might classify that as uninteresting, maybe lazy, but no, I think that there's a reason behind why these signals have come about, and the originators of these trading signals did a lot of research to come to their conclusions, so that's why I use them. Right. Okay, so moving back to the slides. That's your 2 lines again, so I sort of missed out a little bit, but there you go. Right, okay, what do your stochastics show you? Well, in the most basic of instances, falling stochastics suggest deteriorating momentum, and rising stochastics suggest improving momentum, and obviously the turning points of those stochastics suggest, as I've got on this slide here, that when they're beginning to turn lower, that means you're losing upside momentum, and when they're beginning to turn higher, you're losing downside momentum. So it just suggests that certainly in that instance momentum would be improving. There are 2 trigger levels, as I said earlier, at 20 and 80, but again, I'll stress to you, it depends exactly on what sort of market you're trading in, and I'll go into that in a little bit, but the main line, when it crosses above the signal line, gives you a bullish signal when you are trading below 20 on the stochastics, and when the main line is above 80 and then crosses below the signal line, that gives you a bearish signal. So a couple of signals there that you can use them. That's your main line crossover, and that just suggests once again a difference between deteriorating momentum and improving momentum. So your deteriorating momentum would be when your main line has crossed below the signal line, and your improving momentum would be when your main line crosses above the signal line. And there's a little bit of a table here that sort of summarizes the whole situation, as I said, in the most basic form. So when you're between 0 and 20, that's incredibly bearish momentum. When you're 30 to 50 and rising, that's sort of unwinding a bearish configuration. And between 50 and 70, you're increasingly bullish. And I will show you a little bit on the charts now. Okay, so you've got here your stochastics on this chart, and as I said, when you're going from, you've had your signal, you've then seen the main line moving above the signal line at the bottom, and then you start to move into a positive momentum scenario. So your stochastics are rising, and that coincides with the rising price of sterling in this instance. Stochastics above 80 suggests that the momentum remains very bullish, very positive, and then when they start to cross back below 80 is when that's a signal, and that's when you start to get a reversal of that momentum, and you start to get bearish momentum. So the stochastics then start to go with the downside, and your momentum turns negative, very negative below 20, and throughout this downtrend in sterling, this is actually in the past couple of months actually, throughout this period of negativity in sterling, we've had the stochastics through that time, majority of that time below 20. That suggests incredibly weak and bearish momentum, and subsequently when it crossed back above 20, you start to think about that being a turnaround. Now, as it turns out, that rebound was just a rebound within the downtrend, but still it was a rebound nonetheless, and you would have probably been using that as a change of signal, and I'll go through that in a little bit. Okay, so different markets. Now, as I said to you, momentum indicators act differently in different markets. You've got trending markets and you've got sideways trending markets, or no trending markets. So when you're in an uptrend and when you're in a downtrend, you use the stochastics in an entirely different way as to when you are in a sideways trending market. And for that reason, and the big predominant reason for that, and I can't stress this enough, is because you trade in the direction of the trend. So the first thing you've got to do is identify the trend. And once you've identified whether you're an uptrend, a downtrend, or no trend, you can then start to pull together exactly how you're going to read the stochastics. So in an uptrend, you're basically looking for bullish signals in an uptrend. You're looking to buy. You're looking for buy signals, which would be in the instance of bullish crossovers, and those crossovers would be coming between probably 20 and 40. And the reason behind that is because in a strong trend, the stochastics should theoretically be predominantly, I'd say probably between 40 and 90 in a strong trend. Now, in that instance, you're not any sort of crossover signals in sell signals in that you're looking to use those as profit triggers. Definitely do not use those as sell signals, because sell signals in an uptrend is a very risky strategy. I believe, and I continue to stress this throughout all my webinars, that any sort of sell signal you get in an uptrend should be used as a profit trigger and not as an excuse to go short, because shorting into an uptrend is one of the quickest ways, I believe, to lose money. In a similar way, going long into a downtrend is again a very easy way, I think, to lose money, because you might get it right for a little bit, but in a downtrend, any sort of long signals, you tend to see that the sellers resume control quicker than you expect, and any sort of upside targets generally don't tend to be met before the selling pressure resumes. So you'll quite often see it maybe a little bit of profit coming through, but ultimately there generally will be a turnaround and then subsequently downside once again. So just keep that in mind. You're trying to trade in the direction of the trend, and I think stochastics, if used in the right way, can be a very effective tool for doing that. So basically, you're looking to buy in. You're looking for positive signals in an uptrend, and you're looking for negative signals in a downtrend. Similarly, in a sideways market, though, you're looking for different signals. You're looking for classic crossover signals. So in a sideways market, as I said, the tendency will be for there not to be any real trend, and subsequently you'll get the stochastics tending to sort of oscillate between 20 and 80. And on that, I'll bring that chart back that I showed you just now, because I think it depicts this whole situation quite nicely, because this is your situation in a downtrend. You've got this is cable, so you got your sell signal up the top, and then subsequently you've got this whole period here where the stochastics are below 20. Now, prior to that, you had this scenario here where cable was sort of trading in a sideways band, not really doing a great deal. So you were having these signals. You had a couple of signals at the bottom which were actually buy signals that you could have traded, and you could have used that as a sideways trading market, because the stochastics tend to, as I say, oscillate between 20 and 80 when you're in a zero or a no trend market. But when you're in a strongly trending market, you'll either be above 80 or below 20. So that is certainly a signal for how strong the trend is. Okay. So yeah, so your crossovers are basically the way to play when you're in a sideways trending market. So you're basically looking for your main line crossing above the signal line around about that 20 point for a bullish crossover, and your main line crossing below the signal line around about the 80 point to have a bearish signal. Okay, so what are crossovers? Well, as I said to you, this is where this picture here shows you a bullish crossover with the blue line here, sorry, with the blue circle. You've got the main line, which is green, that crosses over the signal line. That is your indication of a crossover or a signal. The confirmation is the big thing in stochastics. You don't trade too soon, because you'll tend to get burned. As I showed you on this cable chart, you had a number of crossovers throughout the bottom here, but when you get a strong trend, you'll quite often get the stochastics bumping along the bottom, and you get a series of crossovers. You actually had a crossover here on the 4th. That would have arguably, if you were going to trade that crossover, absolutely trade it at that time, you would have been out very soon on that, in that downtrend. However, you actually get a series of crossovers through here, but you only get the confirmation of the crossover when the blue line crosses above of the 20 line. That is the signal line. So back on here, that is where this red line crosses above the 20 mark. In fact, this one's set at 10, but again, it depends. That would depend on how liquid the market you are trading at. But most people have the signal lines at 20 and 80. So yeah, that is when your red line, your signal line, crosses above your trigger level, which in this instance should be 20. Similarly, in a sell signal, you have your crossover, which happens here, but then your confirmation doesn't actually come for a few more periods until you get the crossover of the signal line back below 80. And I will show you that now. Okay, so, oops, that's a chart too soon actually. Anyway, okay, so you've got your crossovers here. So you've had, say for example, in this instance here, you've got your crossover, and then you actually don't see the confirmation of that move until the 14th of July. So you had your crossover actually, get my crosshair up, had your crossover on the 3rd of July, so it took another week and a half until you actually got your confirmation of that crossover sell signal. And that is when you start to see the breakdown. And actually, on this cable chart, it actually works really well. You get the crossover even before the sell-off starts going. And even then, you've had your crossover. Look at this, even then on that day. And then the next day, you've had a break to a new high. But then still, you've got the stochastics still falling. And it just suggests that you've got that breakout or attempted breakout to the upside, but then still you had the stochastics in decline. So that would have been giving you a massive signal that there was a false upside break. Anyway, there you go. So divergences. Okay, so divergences. These can be certainly used, well, they're used a lot throughout technical momentum indicators. Divergences are one of the main ways of using momentum indicators. It's basically where, in say for example, you're looking at a bearish divergence, which is where you've got prices pushing to a new prices continuously pushing to new highs, but the momentum indicator, in this instance we're looking at obviously stochastics, the momentum indicator then starts to drop down. That would suggest that there's a divergence between the indicator and the price making higher highs, indicator making lower highs. That would give you the suggestion that there's a loss of upside impetus, as I showed you in that previous chart, and subsequently there was a bearish divergence. Bullish divergence is the opposite, where the price continues to fall through to new lows, but then subsequently within that the momentum indicator, the stochastics in this instance, are starting to make higher lows and therefore diverging, and suggests a loss of downside momentum. So let me just take you through, oh, wrong one. Let me just take you through a few of these in practice. Okay, so I've actually not shown you any charts for a while, and that's why. Okay, so crikey, here we go, back to trending markets again. Okay, well, I'll quickly take you through them anyway. Right, this is your trending market, Japanese yen. You've got a strong trend, and you use the stochastics as a bullish indicator. So you're looking for your buy signals. So when you've got the momentum indicator camped in the bullish portion of the range, i.e. between say 40 and say 90, you're still looking for any sort of buy signal. So you probably would amend your triggers to maybe around between 20 and 40. So in this instance, you've had a buy signal that's come around 30, and actually it's worked pretty well. So you've had your turnover, you've had a bit of a consolidation here, you've had a buy signal, and then subsequently you've gone strongly higher again. You've had a crossover. Now, I'm going to talk about profit triggers again. In a bullish uptrend market, when you get a sell signal, which is a crossover, you use that as a profit trigger, or you either use it as a profit trigger or it is used in conjunction with other indicators. And once again, I will emphasize the fact that you should be using multiple confirmation for your signals. You use that profit trigger rather than a sell signal. So you'd be a little bit concerned about the strength of this uptrend, having seen that profit trigger. Get that. So you've got your profit trigger there. And you actually do get a drift lower. But subsequently, within that drift lower, if you'd taken your profits, you would have then subsequently got a buy signal on this day here. Then confirmation the next day. So you would have started to get back in through this strong run higher, and then subsequently you get a long run higher. You then start to look at the fact that you're in another profit trigger environment. For some annoying reason, my crosshairs are really slow. Anyway, sorry. Okay, so there you go. Not responding. Brilliant. Okay, so you then have another profit trigger, actually, because you've got your crossover there, which comes, this chart ever responds, comes a few days later. Here we go. Okay. Right, there we go. Okay, so you get your profit trigger there, actually, and that one, to be honest, didn't really work that well, because you get a second one, and that again didn't really. I mean, it didn't really work that well. I mean, profit triggers, as I said, you'd be looking at other confirmation, other indicators to say whether you're, how convinced you are that that is the end of that run higher. But certainly that it's probably the secondary use of stochastics in an uptrend. The primary use of stochastics in an uptrend is to look for buy signals, and all these buy signals that you get work extremely well in this instance. So here's the third one, and then you start to see that run higher. Again, this profit trigger actually worked very well, and subsequently you then got a breaking of that, a breach of that uptrend. So you, that one did actually work very well, but it's an indicator that I think certainly in that instance where you've got a strong trend, I think using the profit trigger is determinant on a whole range of factors, and what your trading strategy is, how bullish you are generally, and just a whole number of things. So just be careful of using that or jumping in to take profits when maybe there are other indicators that suggest otherwise. So just keep that in mind. Okay, so you got that, and then you've got your sideways trending market where you use the dips below 20 as your buy signals, above 80 is your sell signals, and this one on dollar yen worked absolutely amazingly for about 7 or 8 months. You had some of the best stochastic signals you could even ask for. So yeah, so trading in a sideways market when there's no trend, which is exactly what happened to dollar yen for about 8 months, 7-8 months. Using the stochastics in that instance works excellently well throughout this whole sideways period. Pretty much all the buy signals and all the sell signals would have given you a decent profit. Okay, so this is euro-dollar, and this is where we've got a whole load of trading signals, and what I'll do now is I'll just zoom in slightly. so you can see it a bit better. Okay, so what you've got here is a big uptrend. So you're looking for your buy signals, but before that, you've basically been trading sideways. So you've sort of not really been able to identify a trend. So basically, prior to that, you're thinking, okay, well, any stochastic sell signals are sell signals, and any stochastic buy signals are buy signals. And again, with this euro dollar, it actually worked pretty well. So there's a sell signal there, subsequently worked very well. Buy signal worked very well. Sell signal worked very well. Buy signal worked extremely well in July. But then you start to see that the move breaking out, and although you've got this bear divergence, which I suppose is still part of that sideways movement, because you've not really broken out yet, and the fact that you're coming up towards the key resistance with this bear divergence in force, you'll probably be a bit concerned by it, but subsequently you actually get another buy signal, so that's okay. But then you get the breakout, and I believe on that breakout you start to think, okay, well, this is now turning into a bullish trend scenario. So okay, so we're going to start to look for the bull signals. Okay, so that bullish signal there gave you a pretty good buying opportunity and a strong gain to the upside. You then had a profit trigger. Didn't work all that well, and again I stress the fact is that you're in a bullish uptrend, so maybe the profit triggers aren't the best way of playing your bullish uptrends. They are just indicators that maybe it is a reasonable time to take profits or start to think about taking some sort of profits off the table. Subsequently, you get a sell signal or profit trigger, a second one that actually does work very well. Okay, so you then go back below your 20 line, and then you get another bull signal, a buy trigger. And this one, again, works very well. You pretty much run this all the way up to the top until you get your profit trigger, which, again, well, actually subsequently does work very well, because for about a couple of months you're actually in a bit of a decline, and you pull back. You're still in a bull phase because you're making higher highs, although you're putting a little bit of pressure on the uptrend, but you're still in this bull phase. So you've identified the fact that you've got lower lows on the price, but you're starting to see a bit of a bullish divergence developing on the stochastics. So you think maybe there is something in a buying opportunity, and once again you get a buy signal. In fact, you get two buy signals. This one actually failed or didn't work so well, although you could argue that this phase here did actually work okay, but subsequently you get a second buy signal here that ultimately worked very well again. You do actually start to then get a bit of a profit trigger back in early March. You start to get a profit trigger back in early March, which starts to warn you about something maybe going on. Again, it doesn't work all that well, but again, I stress to you, you need to be looking at other indicators as well for your profit triggers. But subsequently, you then start to get a divergence, a bearish divergence, where the stochastics have made lower highs, but the prices continue to rise. So you're now beginning to think, okay, well, there is something to be concerned about on my long positions. And subsequently, you do actually get a sell signal, crossover sell signal on that sharp down day, that if you'd used it, would it once again have been a very profitable sell signal. But then you're once again back to the support of this uptrend that's in place. Again, seems to be another higher low in the major bull market, and you subsequently get another buy signal. Now, there are a couple of, I mean, you would have traded that. I would say it's debatable, but I think you would have traded it. Because you have actually got that's a proper signal, so yes, you would have traded it, maybe a touch too soon, but ultimately on the second signal anyway, you get a much better move, and then you subsequently do get a move to the upside. And what are we looking at? Well, got another bearish divergence. that happens. You've got two, in fact, that come. One there, and the second one back in April, May. And that second one, you actually got a signal here, bearish crossover, which is confirmed. That's your profit trigger. So maybe you would have sort of been thinking about the whole situation anyway around this sort of area, but then subsequently you get this bearish divergence forming and another trigger. And I think at that stage you're thinking considerably about closing out long positions, and even subsequently having broken that big uptrend, you're now starting to think, okay, well, maybe shorting positions. You then have a completed double top pattern, so you're thinking even more about short positions, and the fact that so you're sort of flipping your whole trading strategy into maybe more of a downtrend scenario, whereby you're looking for the sell signals rather than the buy signals, and ultimately using that strategy would work considerably well. So you then start to think, okay, well, I need to now look for my sell signals. You don't actually get one for another 6 weeks, and in fact, yeah, because if you'd gone short there, which is possible, depending on how brave you were, having obviously broken that trend and also had the double top pattern, you're probably thinking, okay, well, these sell signals are now mounting up, so maybe sell signals are the way to go. Whether you'd be absolutely short is another matter, because you haven't actually, certainly via the stochastics anyway, you haven't actually had a proper sell signal. This is just your profit trigger. So you actually get your first proper sell signal in July on the euro dollar, and what a sell signal that proved to be. Because that sell signal in July, you're still in it. You would have arguably been taken out, or you'd have arguably thought about your profit trigger on your short position in August, but if you'd stayed in it, and you'd certainly, as I said, if you'd stayed in it and not taken that profit, then you would have been significantly onside. And throughout this whole period, once again, you had a very slight trigger on the stochastics, but yeah, nothing too major as your profit trigger for a short position. And once again, I stress, you would be looking at other indicators for your confirmation. Okay, so question I suppose is, does it work on an hourly basis? Yes, it does. This is euro dollar, and again, as I said, you're looking. Okay, so we've basically identified the fact that euro dollar, this is since July, so that period where euro dollar is in decline. So you've identified the fact that you're looking for sell signals, and on the intraday hourly chart, you've got a series of sell signals that come throughout and pretty much do you incredibly well throughout this whole period. So you've got your first sell signal here. In fact, I've got the blue lines on there, so you don't need to really worry about that. So yeah, you've got your first sell signal here. You do have a profit trigger at the bottom, so maybe you would have used that. But you get another sell signal. Again, subsequently worked excellently well. You get a second sell signal, a third sell signal, just okay, and they keep coming throughout this downtrend, and all the sell signals pretty much throughout this whole process work absolutely amazingly. You even get a bearish divergence on the RSI, a bearish divergence on the stochastics here in August to give you further downside, and suggest a loss of upside impetus in this move on the 4th. And subsequently you get another sell signal. So basically they do work. Stochastics, if you're trading in the direction of the trend, certainly the signals do work, and I do recommend you incorporate them into your trading. I think you've probably gathered through the whole of my chat on the euro dollar over the past few months, the fact that your signals that come against the trend, i.e., well, euro dollar so in that period of the big uptrend, your profit triggers, then you need to be mindful of other indicators and as to whether you do actually take that profit, because signals against the trend in that scenario are not so strong. The major strong signals are coming with the trend, and again, in the intraday situation, that is exactly the same scenario. Okay, so what I'm going to do now, that sort of covered stochastics. What I'm going to do now is look at other markets. I'm going to start off with euro dollar, and I'm going to bring in all the indicators that I've talked about over recent weeks and moving averages I've got on this chart. I've got the RSI, the MACD lines, and stochastics as well at the bottom. Now, the first thing you would say about the euro dollar at the moment is it is horrifically bad momentum, very strong downside momentum, and to be honest, it looks like it's almost accelerating as well, because it's moving away from the moving averages and looks very, very bearish. Not only that, you've broken a whole range of key supports. Basically, this is euro dollar back to July 2012. This is the whole of the bull market run from July 2012, which was $1.2040, up towards the key high of $1.3992. It's now broken all these key supports through this. These were the July and March key lows. They've gone. The November 2012 low, that's gone. And now you would argue that there's no real major support low until the 2040 low of July 2012. So basically that would suggest we're going to get a whole retracement of this move. And the euro looks pretty disastrous, in fact, on that front. Momentum indicators across the board in incredibly bad state. Why? That's gone. Anyway, so yeah, momentum indicators in a very bad state, not looking strong at all, and it looks like the euro will be moving lower. And when my chart comes back online, I can take you through maybe a quick intraday look at the euro. Come on, please. Please, 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 please. Right, there you go. Okay, so on an hourly chart, euro just again, anyone who sort of follows me through my morning reports will just know that I continue every day to say about the fact that you get these sharp downside moves, then a consolidation, sharp downside move, consolidation, sharp down move, consolidation, and that's happened for for weeks now. Any sort of rebound you get just is a chance to sell on the euro dollar, because it just looks like it's ready for further downside. These hourly momentum indicators incredibly weak. RSI consistently below 60 and moving towards oversold. MACD lines consistently below neutral. Stochastics consistently sort of moving towards oversold, and sort of you're looking at these as sell signals. So you've got a midway stochastics at the moment, so no real sell signal coming out yet, but I think certainly the fact that the RSI recently hit to the mid-40s, I think would suggest that that's unwound. That seems to be the consistent way that the RSI has come back towards in the last few days, over the past week or so, and it just looks ready for another bout of weakness. If I zoom in, you'd be certainly looking at old support being new resistance, so 2660 being a new resistance, and also the resistance at 2630. So euro dollar looks pretty bad. Okay, sterling. Bit of a recovery in sterling, but once again, I think that's just going to be a chance to sell. Don't see sterling being anything more than being used as rallies as a chance to sell. God, that's gone a long way out, isn't it? Oh, don't die. Here we go. Right, okay, sterling. What are we looking at? Well, this downtrend certainly still intact, so you're looking for sell signals. You're in this big strong downtrend, so you're looking for sell signals. You actually arguably got a sell signal the other day at 60. As I said, you're in a strong downtrend, so stochastics rallied to 60 and crossed over, so arguably that's your sell signal. You've also had it underneath this key resistance of the downtrend, and on the intraday chart as well. You've lost that key support at 62.82. It was holding up cable throughout all of last week, and now that's become the base of resistance. You've had a rally towards that found it as resistance, so that is now selling pressure. I just think any sort of rally towards that 62.50 up towards 62.80 is a chance to sell on cable, because I think you're going to be retesting that key reaction low from 161.60, and I think further downside subsequently, if you lose that 61.60, you're going to be quite quickly, I think, back towards 60.50, which was that key low back from earlier in September. What is going on there? Jeez. Anyway, thank you so much for helping. Right, so Japanese yen, again, enormous dollar strength. It's just ridiculous in the last few weeks. The strength of this dollar has been unbelievable. Now, you've had, get rid of that, that's old. I don't even know what that is. Okay, you've had this dollar yen moving higher. Look at these momentum indicators, strong across the board. RSI consistently above 80, that's huge. Stochastics also. Now you've got the potential, I did say this yesterday in my morning report, and I was subsequently sort of shot down in the afternoon, but you have the potential for a MACD crossover signal, which would be certainly a warning. I think that would be a warning for the strength of the uptrend, and that I think is not right. That would be if that is the case. It hasn't been confirmed yet. If that is the case, then that would be the first signal, I think, first profit-taking signal in this bull run. We've had this huge bull run that should theoretically now come up and test the 110.65 area, which is actually the August 2008 high, but also is a breakout from a consolidation that's very small consolidation between 108.24 and 109.45 that we had through last week, but the upside break from that actually implies bang on 110.65. So a couple of reasons why I think we're coming back towards there. We've had another high today, 110.08, so we actually hit above 110 today, so that's a remarkable run in the past 6 weeks, back from 102 to 110, so that's like, crikey, 8% almost in that run. It's unbelievable. In 6 weeks, that's just incredible. But at some stage, you can imagine that the dollar might start to find a bit of profit-taking pressure, so you're beginning to be a little bit concerned about, or not, I think concerned is probably the wrong word, a little bit mindful of the any sort of negative signals you might get, and that, if you get a crossover on those MACD lines, then that would be the first one. Okay, I know a lot of you look at Aussie. Again, a huge dollar run, unbelievable. I mean, just the strength of this dollar in recent weeks has been incredible. Now, Aussie, look at that key low there, January 2014, that low 86.58. Now the low today, 86.60. So pretty much to the tick, and that is, I mean, I've zoomed out here over the past few years. What a support that is. That is the biggest support since 2010. So it's an incredible low. If that certainly breaks down, we're sort of back towards these sort of 84 level and the 81 level as well. So just incredible downside that we could still see in this Aussie dollar if that breaks down. We haven't had the breakdown yet, but looking at these momentum indicators, they're all, oh god, they're incredibly bearish. So you'd say that they are still incredibly bearish, and suggesting downside pressure is still in on this chart. Okay, so I'll look at a couple of indices because I know a lot of you, I've had some questions about them. So I'm going to go GDAX. If it ever comes up. Right, DAX. The overriding impact on this chart, I think, is this double top, which actually, if you measure it from that 9.6 down from that 8,990, so that's 290 ticks from 9.6, so that's 310, so 9,310 is the downside target from the maximum downside target from that top, 9,310. And it's not far off hitting that today, 9,357, so we're not actually a million miles away from hitting that target, interestingly, but also that comes in around about that 38.2% Fibonacci retracement level, which did actually prove to be a reasonably good job there. Not a million miles away from that, just about 30 pips away from that low there. So, is this point at which DAX might start to get support? Well, you look at the momentum indicators, those MACD lines gave a crossover sell signal a few days ago, which confirmed this top pattern in my opinion, and suggested that the downside pressure was growing. RSI also topped out and sort of falling back, so it's still got downside potential there, 38 on the RSI, so there's still downside potential. Stochastics are very weak, so that would suggest we've still got further possibly to go in this run. You might well get further pressure on this 9,340 area, and that could well be seen, because today's reaction, actually you've got a bearish outside day. Certainly if it closed below yesterday's low, that would be a very weak signal. And yes, it looks still pretty corrective. On the flip side of that, you'd look at the SPX, S&P 500, and you'd ask yourself, well, where is the support? And the support on the S&P 500 is between 1945 and 1955. Zoomed in a little bit here. It's sort of a sequence of old highs. That old high turned into be supportive through here, and that low there. So it's sort of a cluster of old highs and lows. But also, if you zoomed out on S&P 500, you get what that uptrend is doing there. Certainly not an uptrend. Sorry. From July. Or sorry, is it? Yes, the July one. You get a pretty strong uptrend. Okay, it's not that one. There is an uptrend here. Oh wow. Okay, I think it might be because I'm on log. Anyway, sorry, I apologise for that. But there is an uptrend on the S&P 500. It's just that for some reason my chart, I think it's because it's not on log. There it is. Okay, fine. Well, that's odd because there is a big uptrend on the S&P 500. Anyway, fine. But that seems to be under a little bit of pressure. You've got this support area here. Now, you've also had a bit of a top pattern completed on the S&P 500. So, are you in a corrective mode? Well, you are, sort of, because the RSI is falling away, MACD lines are falling away, stochastic lines are declining as well. So, pretty much across the board, those momentum indicators are not great. But you would still argue that you're above all the big moving averages, and you've not really broken any real supports yet. Yes, you've got this very small top pattern that sort of gives you a downside target, and that was closed below 78 up towards 2000, so it gives you like a 22 downside target of, say, so that's what, 1956, so it's not even, so it's pretty much almost hit a downside target anyway now. So it's not a huge downside target. So I'm still fairly positive on the S&P 500. I'm not that positive on the European indices though. increasingly concerned about the FTSE 100. Oh my God, I've not even seen that in the last day, or certainly today. That downside, another big move downside on the FTSE. It certainly looks like it's going to test that key low now from August, 65.38, 65.29, sorry. And if you look at this FTSE chart, it just doesn't go anywhere. It's incredible, isn't it? It's just over the past 18 months, sort of 16, 18 months, it's just gone nowhere. Just consistently across and not gone anywhere, just consistently, and it's just an absolute nightmare if you're an investor in certainly of UK stocks. It just looks terrible. But you would argue, are you now coming back towards a realm of possible buying area? Well, maybe, because stochastics are coming towards that 20 level, and each time they come there and give a buy signal, it works pretty well. Not had a buy signal yet, certainly nowhere near a buy signal. In fact, it might take some time, maybe a week or so, before you get a buy signal, if at all, on the FTSE. But certainly it just looks like FTSE is under pressure. And certainly that, look at that key support, 6,500. Big level there at 6,500, but that 65.29 mark is the key support. Certainly to be looking at FTSE. Doesn't look good. Okay, gold. A lot of you look at gold. What, again, just dollar strength. It's just incredible. Just pulling gold lower across the board. Just looks negative. Slight pick up in the RSI in recent days, and that's happened as we've had this consolidation. But this consolidation is still. Chart's going to go again. Yep, gone. Okay, I'll just talk briefly. You've had a consolidation in gold that is still drifting lower, and I still think it's going to test 1200. And ultimately, I do actually think we're also going to get a test of that 1184 mark, which was that key December low. However, you would argue maybe that your momentum indicators are beginning to turn around a bit. This RSI has picked up a bit. MACD lines are also beginning to think about turning up. Stochastics through this consolidation have picked up, but to be honest, I'm still treating this as as a selling opportunity. I think any rebounds on the gold price is a chance to sell, and the fact that it's up quite strongly. Let me just look at something. Hold on. No, it's not really shown there. I haven't seen the ISM number. Maybe the ISM number was disappointing. Maybe that's why gold is up. But it looks like still, I think we're going to see further weakness in the gold price back towards 1200, and ultimately, I think you'd be selling into strength if you got a rally. If you've got a rally, I think you're selling into strength. Okay, I've got a question here. That was gold. I've got a question about the Kiwi Dollar, so I will look at that very briefly. I looked at Aussie Dollar recently, just now. Kiwi Dollar doesn't look too dissimilar, does it? It's huge downside in recent days. Not only that, you're back towards these massive lows at 7,700. Yesterday, we saw 7,700 pretty much hit to the pip. 7,707 was that massive low. Look at that, June, July, and August 2013. All these huge lows on the Kiwi Dollar. What an incredible sell-off on the Kiwi Dollar in recent times. You wouldn't really be batting against it at the moment on the downside, because these momentum indicators, although being incredibly overstretched, are still bearish. There's nothing really to suggest that you certainly, my good Lord, certainly would not be buying Kiwi Dollar. You might well, if you've got a short position on Kiwi Dollar, you might start to think about how the fact that it's incredibly overstretched to the downside, and maybe you're into sort of technical rally, sort of dead cat bounce territory. But I think you'd be incredibly well, it'd be incredibly brave, and I don't even think brave would be the right word, to buy the Kiwi dollar at this level. At some stage it will recover, but I think the technical signals are certainly not suggesting anything really yet, and I think until you get any sort of signals which are not coming through on any of these three momentum indicators, I would not be buying it. I've just got the just looking at just everything really, just how the fact that it just across the board it is incredibly weak. The only saving grace you would argue is that you've got that massive support from those key 2013 lows at 77 big figure. If they went, you're looking back at 75 and 74, so of those 2011, 2012 lows, but it just looks incredibly bearish still. As I said, you may well get a dead cat bounce at some stage that would be a chance to sell, but I think just buying the Kiwi dollar at the moment is an incredibly risky trade. And I'm going to finish off with silver. Gold and silver, both incredibly weak. Look at that breakdown in silver. Now there's a big descending triangle that I haven't drawn in here because it shows better on the weekly chart. That actually gives you a downside target of 16.70. Not too far away from that now, about 3% away from that now. 3.5% away from that now. So it still looks very weak. Gold and silver both across the board, very, very disappointing. Okay, so thank you very much for listening to me today. We've got our next webinar in the series, which is on Bollinger Bands. Now, Bollinger Bands is different aspects of technical analysis. It sort of looks at volatility, and I know a lot of you do. I've had questions before from you about volatility, so I think it will be an interesting one for you. I hope you'll enjoy it, and it's on Wednesday the 15th of October, again, same time at 3 o'clock UK time. My Twitter handle is @HantecRich, and if you've got any questions on anything, then please feel free to email me or email the team at marketing@hantecfx.com. And I wish you good luck in all your trading, and thank you very, very much for listening to me today, and I will speak to you next time. Thank you.